Hello and welcome to AFM 451. The goal of this video is to introduce audit risk, what it really means, why it sits at the center of audit strategy, and how it frames every significant judgment an auditor makes. Auditing is not about guaranteeing accuracy or predicting whether a company will succeed or fail. The auditor's role is narrower but more precise, to issue an appropriate conclusion or an opinion on whether the financial statements are reasonably free of material misstatements. Audit risk exists because judgment is made under uncertainty. At its core, audit risk is the risk that auditors issue an inappropriate, clean audit opinion when financial statements are materially misstatement. That definition matters. It anchors audit risk to the audit opinion rather than to the business outcomes, stock prices, or client's performance. Audit risk is the auditor's risk. Management is responsible for preparing the financial statements. Auditors are accountable for the conclusion we issue. Another way to think about audit risk is the probability of reaching the wrong conclusion. That wrong conclusion can take a couple of forms. On one side, auditors may conclude that financial statements are materially misstated when they are not. This leads to an unnecessarily modified opinion. From an assurance perspective, this is inefficient. Audit work overshoots what was needed and imposes costs without improving decision usefulness. The more serious concern is the opposite error. This occurs when financial statements are materially misstated, but the auditor concludes they are fairly presented and issues an unmodified or a clean audit opinion. This is an ineffective audit. Now, users rely on views to make decisions, and the assurance function fails its core purpose. This trade-off highlights why auditors talk about an acceptable level of audit risk. At the beginning of an engagement, auditors implicitly decide how much residual risk they are willing to accept that the financial statements could be materially misstated after the audit is complete. That threshold drives the nature, timing, and extent of audit procedures. Lower tolerance for audit risk means more persuasive evidence is required. Audit risk also explains why audits are risk-based rather than exhaustive. Remember, reasonable assurance, not absolute. Auditors operate under time, cost, and cognitive constraints. The objective is not to detect every error, but to reduce the risk of issuing the wrong opinion to an acceptably low level. Materiality, professional judgment, skepticism all flow from this reality. You will often see audit risk expressed through a model that breaks it into components related to the client and the auditor. For now, the key point is conceptual. Some risks arise from the nature of business and its controls, while others arise from the limitations of our audit procedures. Only the latter is directly influenced by auditor effort. This distinction becomes critical when designing an audit strategy, and we'll unpack it in detail in the following video. Consider a fast-growing tech company approaching its first public offering. Management has strong incentives to present stable earnings and optimistic asset values. The auditor knows that estimates around revenue recognition, capitalized development cost, and impairment involve judgment and uncertainty. Setting a low acceptable level of audit risk means the auditor cannot rely on surface-level explanations. More persuasive evidence is required. Independent corroboration, deeper testing of assumptions, heightened skepticism is applied. The objective is not perfection, but confidence that issuing a clean opinion is appropriate given the risks. Thus, audit risk is the lens through which audit strategy is formed. It connects professional judgment, evidence, and the audit opinion into a coherent whole. Thanks for following along. Take care, stay safe, and bye for now.